Now, Charlie Aitken is the founder of Aitken Investment Management, and he has a number of investment themes which he thinks will make his fund money. We'll explore them and ask him if he's positive or negative on the outlook for stocks generally. And I want to ask him about why the banks are getting beaten up so much. Charlie, how are you?
Hey, Pete, good to see you in person for once. Doing this a bit remotely lately.
Yeah, that's true. You were in my seat, weren't you, as well? No. All right, now, mate, look, I've got a lot of things I want to talk to you about, and I'll give you plenty of time too. But the banks, why are they getting beaten up so much?
They're easy shorting for global hedge funds, obviously. ANZ didn't help proceedings the other day by lifting its provisioning ratio a notch. That obviously gives people ammunition from the short side. If you look at it, there's a general view out there in the international world that Australian housing is cooling, Australian bad debts are going up a little bit, and the banks are expensive globally and they can't value the franking credits. So the short positions in the banks now are the biggest we've ever seen in terms of dollar value. So people are betting on them going down. Not going down as in going broke, as in the share price is going down. And quite frankly, up until about 2 or 3 weeks ago, they've been right a lot of the time. But I think, we're near the end of the quarter and some of these shorts start pressing the issue. So you had the ANZ increasing their provision, plus, Fortune, or what was it, Forbes magazine came out with, Australia's going to have second biggest chance of a debt crisis. Well, okay, when and where, But anyway, but today you'll find that near the end of the quarter, big short positions get pressured, and that did happen today across the market. And there's plenty of things up, though. So if you look outside the banks and Woolworths and things, there's plenty of things up today as well.
You're kind of saying that the fund managers who are shorting the banks are going to really try and push early in the week and to try and, in a sense, make money on driving the share price.
Look, we do short things too, okay? So I'm not pointing fingers. No, but the idea of shorting is to create a bit of price action, to make people worry about what's going on, right? So the bigger impact you have, so when ANZ comes out with a little bit of an upgrade to its provisioning, $100 million, what do? You wipe $2 billion off its market cap.
Okay. Well, I've got a chart here, Charlie, which I think puts the whole thing in perspective. I'll bring it up in a second, just showing us how exposed our banks are. This shows how exposed our banks are to mines in the share of total loans of Australia's big four banks. So CBA is 1.8%, Westpac's about 1.5, ANZ's about 2, and NAB's about 1%. This is not a sector scarily exposed to the mining sector.
No, and I think that's absolutely right, and I think that's broadly understood. I think the big shorters of Australian banks are playing a housing play. They think house prices are overpriced. They think that banks have lent, ludicrously or whatever it is. The house price.
They don't think we're going to pay back our.
No, we're never going to pay back our mortgages, and we're all going to be unemployed. And that you don't need much of a default rate for the dividends to be at risk. And that is actually a valid argument in logical steps. But whether it happens or not.
But this is a country, an economy that's growing at 3%, and America is wondering whether it's growing at 1%.
And we've got 5-point-something% unemployment. Things are pretty okay on the East Coast at the moment. I think, look, the logic of why they're shorting them, if it played out like that, is absolutely correct. The banks would cut their dividends, need more capital, and bank share prices would go down. But at this moment in time, house prices are pretty steady, unemployment's pretty steady, and GDP is actually growing. So, and the bank results coming up, give or take a little bit more provisioning, will be okay in April. And so,
and I love this fact. It gives in Bloomberg today that low doc loans arrears in Australia are 4.36%, and they make up 1.35% of our total RMBS. Like, that is just showing that this sector and our banks aren't badly exposed to housing. It would have to be a recession where unemployment goes to 10% before these guys are right.
Look, it's all about unemployment, right? The simple fact is the banks own you in Australia, right? You can't get out of it. It's not like the mortgage in America where you can give the keys back to the house and drive off in a Ferrari. That's how you can do it. That's what went wrong with the American banking system. Here they own you. They own your car. They own your Labrador. They own everything, right? It's not as easy as that. Unemployment and employment growth is the thing to watch, right?
Okay. The bottom line, from my view, is this a buying opportunity for the long-term investor, the banks?
I think specifically we're taking ANZ out of the equation, which seems to be the problem child. I do worry about ANZ. I worry about their Asian exposure. I wonder what they've got up there. I don't worry much about the Commonwealth Bank. I don't worry much about Westpac. So I think selectively it is. But the point is probably, Pete, most Australians have enough banks.
Do
you really need some more?
There could be someone who's sold at the top and wants to know. So some brilliant viewers here may have sold at the top and want to buy back in.
Look, don't always believe the price action. The price action can be quite dramatic. Remember, on the day of the big Fin Review article of the Big Short, ANZ bottomed, I think, at 21 90-something. It then rallied 16% in the next 2 weeks. So the price action can reverse. But look, I think there's nothing else. There's a weak thing to say. I would expect further volatility in Australian banks. When there's big short positions like this, you can get big moves up, big moves down, and it's almost in the interest of those positions to create the volatility.
Okay, mate. You recently, I heard you speak at our investment day. And
Good of you to come along.
yeah, given the fact it was called the Swiss Strategy Day. But I love the themes. I think my viewers will benefit from hearing from you. You identified 6 or 7 themes that are driving the way you're investing in your fund.
Look, I mean, one of the problems with Australian banks is they don't have any growth at the moment. They're not really growing their earnings or dividends, and I tend to invest in things that grow. I believe if a company can grow its earnings and dividends, that in theory its share price should grow. I mean, it's pretty simple, but we look for macro tailwinds first. Find a sector where something's growing, and then try and find the best stock or series of stocks that have leverage to those themes. So one of the reasons I'm not outright bearish on markets is you can still find plenty of growth themes. Plenty of sectors are growing, plenty of companies are growing, plenty all around the world, not just and in Australia.
And
so,
what percentage are you Australia and overseas?
At the moment we're about a third Australia and the rest is overseas.
Is Australia mainly for income?
No, well, it's a little bit Australia for income, but I still can find growth in Australia. A lot of our biggest bets in Australia are about leverage to Chinese international tourism.
That's your first thing.
That is my number one and biggest theme, is the Chinese international tourist. Over the next 3 to 5 years, I think it's absolutely...
What's the standout company for that then?
Well, it's probably the easiest one to own is Sydney Airport as the international gateway. It won't go up 5, with great leverage. We also have big bets in pardon the pun, in Star Casino. It dominates the East Coast casino side. We have positions in Macau casinos as well, but it also helps Qantas, it helps Sydney Airport, as I said, and the multiplier effect of tourism, international tourism, is enormous.
Okay.
And I think it's a great theme. I think it's helping the East Coast at the moment. Look, Star Group made a 6-year high today in a market down 80 points.
Well, those people who heard you talk about it 2 weeks ago would be loving you today, Charlie.
Well, you can fall out. They can fall out of loving me quickly too. But
Let's go to your second theme.
Second theme is the cashless society. A little bit harder to play in Australia. How none of us really seem to use much cash anymore.
Tap and go.
Tap and go. Visa, MasterCard, American Express, PayPal, that sort of thing. So we have positions in those around the world. Other things I like, which is more relevant to Australia, a lot of the themes I like aren't that easy to play in Australia. I still love the compulsory superannuation theme in Australia. I think the growth in compulsory superannuation and people who service it is going to continue for some time.
What's a company that...
A little one that I mentioned at your thing was called Class 1 Super. It had a good day today. It was up about 4%, code CL1 in Australia. We also like Link, the registry services business in Australia.
Good solid company.
Yeah, it's just solid. They day in, day out provide services to superannuants. We're looking for other ones. Another strategy I like is just monopoly toll bridges. Again, Sydney Airport fits in that. Things like Transurban, Macquarie Atlas Roads, Beijing Airport, Mass Transit Rail.
You buy those primarily for the income, but you believe
for growth. They're growing.
There's growth.
They're growing.
Well.
In a low interest rate, low growth, low inflation environment, toll roads and airports are actually growing. It's not just about low interest rates. If you drive around, even my little trip up here to Foxtel this evening, God knows how many tolls I paid Transurban on the way. But they're cashless. You don't even know.
Does Transurban sort of fit into like that Ramsay stock, which always look PE-wise, unbuyable, very low dividends, but it just keeps going up because it's just in a perfect little spot?
If there was a single stock that I could feel comfortable owning for the next 20 years in Australia, I think it actually is Transurban. Dominates Brisbane, Sydney, Melbourne toll roads, interconnectivity, toll rises beyond inflation, great assets. It happens to be a publicly listed company when most of these assets are generally privately held now by Canadian pension funds, and you saw the demand for Asiano and things like that. So the ability and the liquidity advantage in Transurban being listed on the ASX, I think it's a wonderful thing. I think that's, as Warren Buffett says, a monopoly toll bridge is my dream investment. Well, Transurban is a monopoly toll bridge. Dominates the East Coast. So they're the sort of themes we're into, and those stocks have been performing well. It's when you look at the index on days like today, on the Thursday before Easter, the entire index loss in Australia was the banks. Plenty of things are up. Today, banks and resources a bit today, and plus a bit of Woolworths, but there's still plenty of things up. And I know it's a cliche, but it is a market of stocks, not a stock market. And there are plenty of companies in Australia growing.
Charlie, when you see those headlines, I think Money Morning has it all the time, the recession of 2015, the recession of 2016, the recession of 2017, what's your view? Do you think this is just typical that there's always a contrarian out there who wants to talk it down. You often say that you're only a sage if you're a doomsday merchant.
Well, no, you're considered smarter if you're bearish because you're different and you must be a wise sage. And there's times to be bearish and there's industries to be bearish on, but being bearish all the time is not how you make money. And look, I think there's a business in the new age of media with instant everything and headline grabbing and Twitter and Facebook. You need to have quite a dramatic headline to get people to click through to actually get advertising dollars. And I think, you know, it does make me laugh that in Australia in particular, the market goes down in billions and up in points. Every time we fall, we're down in billions. I'll guarantee the viewers tomorrow morning, the Australian share market fell 28 billion or something yesterday. Today. 28 billion. It'll be down in billions, not points.
Okay.
But look, it's prudent to be sensible, right? But I'd ask there's a lot of the scaremongering and things is actually to scare the non-professional investor out of investments, and I think there's always a balance in these arguments.
From your point of view, obviously you don't ignore the negative views.
No, definitely not.
And ultimately, you have to test them.
Correct.
And at the moment, there's some people out there. In fact, a bloke who went to the same school as you, who'd been an investment banker, thinks that commodity prices will collapse again, and that will be the start of a new leg down.
Could happen.
It could happen. But
I mean, like, we're all having a shot at the future.
What's your argument against that, do you think?
Well, you know, the US, everything's denominated in US dollars, and, you know, at the end of the day, the US dollar looks a little bit toppy at the moment. Chinese house prices are actually accelerating at the moment. Inventories in iron ore look a little bit low. Don't get me wrong, I'm no great commodity bull. Oil capacity is being turned off a little bit in America. The inventories are high in America, but, I mean, the oil price just rallied 50% from its low. No one noticed. It just went from 25 to 40. You know, things like that. So,
but do we need the world economy to end up growing stronger than what it was expected in January when they were all selling off? And I noticed that the last economic reading on Europe was better than expected.
We just need to muddle through. You know, it's like it just needs to be less worse. I mean, at the end of the day, if we've got muddling through economic growth, a bit here, a bit there, we'll find some earnings growth, which means we can make money in the right stocks. But look, I think there's a whole business. I mean, I was probably in it myself a little bit when I was a broker of making noise.
But you were very noisy.
You know, but now you
drew my attention through your
but
noise.
you can be too noisy. You know, the noise attracts attention, right? Doesn't mean it's always right.
Okay, let's just go to Yellen speaking tomorrow. And what bothers me is that we hang off.
The fact is, we know. That's the problem, that we know that Yellen speaks tomorrow.
I know.
What's she going to say?
But the thing is this. Aren't we praying,
why do we care?
Aren't we praying for the time when the Americans raise interest rates on the basis that the economy is looking good enough?
I don't know how many times I've said it. If the Federal Reserve truly believes it's confident enough to put up interest rates, albeit slowly, it is a sign they're confident in the sustainability of American GDP growth.
I would have thought so.
And the markets then balk. And see, the Fed says they're data dependent. They're not. They're beta dependent. They blink every time the markets fall. Markets fell in February after a January fall. Suddenly, Fed governors come out saying, oh, no, we're not going to raise rates. Markets rebound, US dollar comes down. And here we are again. We're playing this game of, and then it looks good and they'll start talking about raising rates and markets will probably come down again. But I think the fact that everyone hangs on every word from every Federal Reserve official is almost pathetic. And it's not how to make money, it's how probably to lose money listening. Let's face it about central bankers. They know not much more about what happens tomorrow than you and me, Pete. In fact, it could be argued they know less. They're dealing with the same data.
Yeah, that's right.
You know?
And so, look, from my point of view, looking at what we're seeing, do we need to have a bit of I guess it's a more important question. GDP in the US doesn't look good, but employment numbers look fantastic. What do we believe? GDP or employment data?
I suppose, again, the truth probably lies somewhere in between, but what rate or what wages are those people being employed at? They could be low-paying jobs. GDP growth gets affected by inventories and plane orders and defence spending. Then we just got the third revised estimate of GDP growth from America. Like, the first one doesn't matter. The second one, it's all revised later. I'd look at company profit growth, and I think American company profit growth is going to be a bit weaker this quarter, but that's quite specific that the strong US dollar took a bit of that out. I think America's going okay. I really do. And I think they're probably in a strong enough position to put up rates. Reporting season's going to be interesting, but they report every quarter. I mean, it's almost too much.
I know.
Almost too much. Look, I think of all the economies in all the world, a lot of the money of our fund is in America. I still feel very confident about America. Very confident about American technology. Very, very confident about numerous parts of the American economy.
Well, on that positive note, I say thanks very much, Charlie.
Thank you, Plato.
That's Charlie Aitken from Aitken Investment Management. Coming up after the break, it's official, unlisted property is the #1 asset class. We'll take a closer look at it after the break.